Saturday, December 7th, 2019, MONERO 64, home of alternative economics and contrarian views. A lot to talk about today. Of course, the U.S. jobs data yesterday, how the markets reacted. Most importantly today, I want to talk about how I think, and I can show you that the Federal Reserve is actually monetizing the national debt now, and increasing their balance sheet, right? Before I go into that though, today is a very important day in terms of World War II, December 7th, the day that will live in infamy. I think it was FDR who said that after the attacks on Pearl Harbor by the Japanese. So if it wasn't for that attack, the US would not have entered World War II when it did, right? It might have entered it later, who knows? But one thing I want to say about Pearl Harbor is that when I was about 16 or 17, I did a research paper in high school. I went to the American High School in Rio, in Brazil. We had a very nice library, so I used a lot of references, a lot of books about the event. One thing that I always remember though, in one of the books, they talked about how the people high up in the administration, U.S. administration, were aware that the Japanese were planning something. They might not have known the exact date, but they were aware that that was the intention of the Japanese, right? So I'll stop at that, right? Let's come back to the present and look at the markets, economics, and money. That's what I try to focus here. Keep an eye on the money, where it's going. Try to stay away from politics. When I talk about the markets and what's going on, I'm not trying to praise anyone on any political side, right? I wanted to make people aware of that. I don't care who's in power, left or right. I've come to the conclusion many years ago that it doesn't matter who's in power. There's always another power behind them that is too strong for us to fight. But let's go and look at the non-farm payroll number. So the expectation was for 186,000. The number came out at 266,000. That was the non-farm payroll number. So looking at that headline, the algo machines went crazy, right? So that was a good number. Let's look at the other components. I'll come to the non-farm payroll in a minute, the details of it. Well, we saw average hourly earnings, which I said yesterday, the Fed likes to keep an eye on it for inflationary pressures. Well, that came out at 0.2%, which is quite good for them. It was expected 0.3, so they've got an excuse that there's no inflationary pressures, right? So that was good for them. What's the other one that I think sticks out? Well, the labor force participation rate, the percentage of people that could be working, that are working, well, that dropped from 63.3% to 63.2%. How is that possible? You had such a good number and the participation rate drops, right? So that's the other point I would make. The other point I would make as well, that one of the US's biggest trading partners, Canada, had their jobs data as well. And employment in Canada was expected to rise by 10,000 and it dropped by 71,000. Of course, it's a different country, but their unemployment rate went up from 5.5% to 5.9%. So it doesn't make sense that one of the US's biggest trading partners is not doing well while they're doing well, right? Just wanted to put that out there. In terms of the non-farm payroll, there's a very good article on Zero Hedge, and I have to say, I do look at Zero Hedge, of course, but I don't really buy into a lot of the stuff they say. They do a little bit of clickbaiting, but they've done a good analysis here. Why the main reason for today's blockbuster jobs report, and they point out that they added 41,000 of GM workers that came back from striking to the number, right? And of course, they had also decreased it the previous month, so it nets out. But what I'm trying to say is a lot of that extra job in manufacturing was because of workers returning to work. It wasn't because new jobs were created, right? Zero Hedge, of course, points out that the same thing happened in reverse the previous month. So we need to take that into account. The other point they make is that employment growth has been mainly coming from education and health. The fact that more and more of the population is getting older, people need carers, right? And the employment growth in those sectors, education and health, is growing, while the total non-farm minus education and health, it's not shrinking, but the growth rate is declining. The other point they make is that since 2010, there's only been 5 months out of 117 that the number of food services and drinking places jobs has decreased. So there you go. That's dissecting the numbers. Of course, when it comes out in a dealing room, and I've worked for many years in the markets, these numbers come out, the markets just go crazy, right? Depending on whether it's way out of expectation. And this number was way out of expectation, the headline number. So there's no time to look at these details. And when people do look at these details, it's too late because the market has moved. So of course the Dow finished up 337 points, over 1%. S&P finished actually under 1% higher, up 28. And the NASDAQ 100 finished just up 1%. I was out yesterday afternoon, London time, when this number came out. I actually was playing a Christmas golf competition for one of the golf societies in my club. But I saw after I finished, or even on the course, I looked at my phone, I saw that the markets were going crazy, and I figured that it was probably a good number. I would have expected the bond market, though, to do a lot worse in terms of the yields going up. But looking at the yield here, we're at 184 in the 10-year. Yesterday morning before the number, when I made my video, it was at 180. So the bond market didn't drop as much. I remember back in the 90s, I was working for Citibank in the mid-90s, and I remember these numbers used to come out like 400,000, 500,000 non-farm payroll. And I'm not defending Clinton or anything, but that's where the numbers used to come out, and we used to bet on how much the numbers were going to be, right, in the dealing room. One thing I can say, though, back then, if the numbers were too strong, the headline number is too high, the stock market actually would go down, bond markets would drop quite a bit more. And why is that? Well, because people would expect, or investors in the markets would expect, the Fed to be less accommodative because the economy was doing very well, and they would be concerned about inflationary pressures, right? But nowadays, you get a really strong number like we did yesterday, supposedly strong. You get a little drop in the bond market, and you get a huge move up in the stock market. So as I said yesterday, even if the numbers had been weak, the stock market would have gone up because people would expect the Fed maybe to be more accommodative. But the flip side is that it also goes up even though, because the Fed is never going to be, how can I say, hawkish anymore, because they can't. And I've spoken about this, and I've spoken about fiat money inflation in France when the French experiment with paper money ended in disaster after the French Revolution in the 1790s. They started printing the assignats. It was reluctant at first, but then the economy improved, and then it went down again. They had to keep increasing and printing the assignats, but it came to a point where everything imploded because people lost faith and confidence in this fake wealth that was being created, and they couldn't. And the other point about this book that which I read many years ago that makes me believe this is the same thing that will happen is because they can't get out of this. They got to keep inflating. But if countries could print their way to prosperity, Zimbabwe would be the richest country in the world. Weimar Germany would still be around. Venezuela would be doing really well, right? And I'm not saying the US doesn't have positives, its economy. The underlying economy in every country is very positive, in my opinion, but it's the monetary part that is screwed up. But at the same time, you need the money for the economy to run, right? What about gold and silver? Gold and silver, of course, got hammered yesterday right after the number. Does it mean it's bad news? I don't think so, because if you look at the technical picture here, gold, the weekly chart, we're still within that falling wedge. Yeah, it wasn't a great week, finish to the week. We're still above the low from the beginning of November 11th, or thereabouts. And if you look at silver as well, still within that flag. So I'm not concerned. I'm even more determined that gold and silver will protect you in the coming mayhem. And I'll come into that in a minute here to show you what the Federal Reserve is doing in spite of the stock market doing so well and the economy doing so well, right? It doesn't make sense. What about the stock markets? Let's have a look at the charts. Well, this is a weekly chart of the Dow. Yeah, we finished right near the all-time highs there. We did get below that trend line, as you can see there, earlier in the week. But that's how it's looking. S&P, similar picture, as you can see there. So now to the Federal Reserve. Before that, I'll look at an article from the nationalinterest.org from November 1st, 2019. It says national debt passes 23 trillion. It's a historic high, right? And this November 1st, national debt tweets 23 trillion, 8,409,564,494.99. National debt. That's about a month ago. So you look at the national debt now, 23 trillion, 100 billion, 404 million, 600, wow, it's moving so quickly, I can't give you an exact number. So that's up 100 billion in a month. So now let's go to the Fed's balance sheet, right? The Fed doesn't want to call it QE, right? They're increasing their balance sheet, but they don't want to call it QE. The other thing I would say, some people would argue that the money the Fed is creating has to be lent into the system. Yeah, technically the Fed lends the banks money. The banks take that money and they lend it to the US government, to Uncle Sam. The Fed doesn't do it directly, or else it will look too obvious. But one thing I would say, with rates under 2% and inflation higher than 2%, they're not really lending in real terms because the real rate is negative. The other thing I would say, where does the Fed get that money that they lend? Well, they create it out of thin air. They don't go to the Klondike, as I've said before, or South Africa and mine for gold. I've never seen a Federal Reserve bank or Federal Reserve system mine anywhere in the world, right? So no, they just create it out of thin air to lend it basically out of thin air these days. So if we go back 3 months ago, September 5th, 2019, roughly 3 months ago, we've got a balance sheet at 3.8 trillion, right? 3,809 billion. We go to the latest data, December 5th, a couple of days ago, 4,113 billion or 4.1 trillion. That's an increase of 303 billion dollars in 3 months. That's $101 billion every month. And as we just saw, the national debt is increasing by 100 billion a month. So yeah, the Fed is monetizing the debt. Of course, they're not going to say that. And they're also not going to say it's QE or that they're printing the money. They say it's a technical exercise. The other point about the national debt, if you go back 4 years, you can see the debt to GDP was 106.41%, the debt to GDP ratio. Right now, it says it's 106.67. So it hasn't increased that much, that debt to GDP ratio, but it has increased a little bit. But the key here is the GDP. If GDP starts dropping, if we go into recession, that number is going to zoom up because the national debt never goes down, right? So, and what's keeping the economy from imploding right now in the US? Well, I think it's the stock market. It's the only thing that is making the economy look good. It's giving a little bit of a wealth effect to the very top, which is trickling very slowly to the bottom or not at all. And if you look at all the other countries in the world, we saw some really weak data from Germany recently. We're seeing the weak data from Canada, all over Europe, like we have protests in France. So that's the key here. That's why they're fighting so hard to keep the stock market up, because that's the only thing that's keeping the economy going for now. So my take from what's happened in the last 24 hours with the US job data, with the markets, with precious metals, is that we need to look under the surface to see that things are not really doing very well. The debt is still ballooning. It's still a problem. The central bank, the Federal Reserve, is doing QE, even though things are supposed to be great. So what's the problem with this picture? Well, in my opinion, the problem with this picture is that a lot of people out there, the general public, they don't look at things like we do here in this channel under the surface, and they continue to live and spend and borrow as if everything was great. Those are the people that are going to get really hurt when things turn around, because things, in my opinion, are not as great as they are. And I'm not criticizing any politicians here. I'm just looking at the numbers. We could have, I don't know, President George Washington right now as president, and I would make the same comments about the economy, right? We could have Abraham Lincoln or JFK. I don't care who's president. So that's what I'm trying to say. Look under the surface. Keep an eye on the GDP numbers. Keep an eye on the debt. It's all public information, right? Keep an eye on the Fed's balance sheet as well. I'll put a link to it below in the description. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. If you haven't subscribed to the channel yet, think about subscribing. If you've subscribed before and have been unsubscribed, make sure you subscribe again. I've heard that YouTube sometimes unsubscribes people from the channels they follow, right? You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.